Welcome back to another episode of In the Money. I'm Roberta King, and with me today is Jessica Inskip, Director of Education and Product of OptionsPlay, and Tony Zhang, Chief Market Strategist of OptionsPlay. Both Tony and Jessica are frequent CNBC guests. Jessica, Tony, welcome. It's always great to be back with you.
Thank you so much for having us, Roberta. I look forward to the conversation.
Yeah, thank you so much for having us. It's a pleasure to be here, Roberta.
Likewise. All right, so today is Thursday, August 24th. And in last week's episode, we were experiencing a shift in market sentiment, talked a lot about that. And so, Tony, I'd like to get started with you today and see what you're noticing in the economy this week.
Yeah, thank you so much. Over the past 3 weeks or so, we really have seen investor sentiment sour quite a bit over the contagion risks out of China. But this week, we really saw a bit of a bid that the markets caught over the last week or so, some anticipation of Chairman Powell's speech tomorrow, as well as NVIDIA earnings that came out last night. And the question, I think, for a lot of investors was how far could this rally go? And I think today's price action may have given us a little bit of a clue here, because last week I talked about the 4450 level as a major resistance level that is now broken by the S&P 500. And what we saw price action from this week is that we've rallied up to that level, and now we've we've bounced off of that level to the downside. And what that confirms to me is that that 4450 resistance level so far is holding. And I'd like to see a close this week below that level to solidify that that resistance level is holding, and perhaps the next leg down is towards my $4,100 target to the downside on the S&P 500. But I actually think the more important chart here to look at is not in equities, but in the bond market, of looking at that 10-year yield, because yields really have a large influence in terms of valuations from an equities perspective. And when we look at the 10-year bond yield, we're back near that 4.3% level that we put in earlier this year. And that is a double top. Then my concern here is that if we break above that 4.3% double top, we're headed back to 475, perhaps even as high as 525 basis points on the 10-year yield. This is a chart that's going back. We're talking a multi-decade bearish trend line that has been broken. And right now, the question is, how much higher can yields go? Because as yields continue to move higher, that certainly puts a limit as to how much higher equities can go as well.
Yeah, those are some really interesting charts, Tony. So I was hoping you could talk a little bit more about how you can read into the 10-year yield, and then why is that indeed a limiting factor for equity growth?
Yeah, that's a fantastic question. And it really has to do with the fact that when we value equities, we have to discount the future earnings of the company back into the present. And when we look at the sectors that have led this market higher, just consumer discretionary, technology, communications, these are sectors where a lot of the future earnings of the company is weighted into the future. And that really is a concern, because when you use the interest rates that are higher today to discount those future earnings back into the present, you have a lower valuation. And that's one of the biggest concerns, because equities are a forward-looking mechanism. We're valuing these companies based on how much they can potentially earn in the future. And when that is lower based on today's value, that's going to put a lower valuation on equities.
That's helpful. Thank you, Tony. Those insights are appreciated. So, Jessica, I'd love to turn to you next. And last week, and really over the course of the last year, we've been talking. I've noticed a trend in conversation around technologies, AI, and other emerging areas from you. So I'm really curious to know what your macro view on the economy is this week.
Yeah, and to Tony's point, it's really the question of, are earnings trumping yields? And that's certainly could be a risk when yields get this high. But that's why we want to take a deeper dive into earnings. So pointing to NVIDIA earnings, beat all around, and they raised forward-looking guidance. But the reason why I saw this of the uttermost importance is from really an insight perspective. We are trying to understand this AI demand puzzle, or the AI boom. Does it have bubble factors? And the way to look into that is to understand if revenue is actually there, and if there is real demand, or if it's a demand pull forward. So to Tony's point, those future expectations, are we just pulling them into the current price, which means perhaps it is absolutely overvalued, especially in comparison to the yields. So we saw absolutely demand and revenue, which is a interesting insight from the overall AI picture. Now, the question that I want to broaden that out to is when we're marrying this with the information that we're expecting to get tomorrow from Jerome Powell, is this deflationary environment and this expected growth expectations, especially from the Atlanta Fed and this positive GDP numbers that are projected, can those happen at the same time? And if that answer is yes, then it would have to be, at least in my opinion, a productivity story. And so in order to getting insight into that, it's important to look into the demand and the development of AI. And since chips and NVIDIA is a key component of the beginning stages of that, it's insight into the AI boom, but more so the economic impact of a productivity boom. And we're seeing productivity increase. Even there was Fed chair speak this morning that said that heard that increasing, but we want to see that reflected within the data. We did say that we're going to talk about home sales data, and I think that's extremely important as we think about the bigger picture and also as we focus in. There was some key data that occurred last week, which is new home builds and existing home sales. So the sales of the new homes and existing sales. There's also a supply side issue within homes, and that tends to be exasperated or expanded with those higher interest rates. Now that those are going to higher levels, the affordability of housing is certainly coming down. So anyone who has a mortgage now, it tends to be holding on to their low interest rate inclusive of their house, further diminishing the supply. So it's interesting to see how that played out in the data. New builds absolutely grew, continued to be resilient. They were increasing 4.4% month over month, which led to 32% year over year of an increase. Existing home sales, though, they were on the decline, down 2.2% month over month and down 16.6% year over year. So it's interesting to see how that is actually playing out in the data. There's new builds are growing, existing home sales are shrinking, and that absolutely has to do with interest rates. So it all certainly goes together. And then, of course, to Tony's point, and I want to make sure we reiterate, is the market is absolutely has this anticipation, or there's been a lot of talk around Powell's speech tomorrow and how he's going to give us the state of the economy is I believe what it was called. So it's going to be interesting to see what he says and then subsequently the market's reaction.
Agreed. Thank you. It's really, I always find your perspective thoughtful and with some depth to it as well. I find myself often talking about it, even last night, talking about when there are like two conditions where they're opposing things that are happening at the same time and how all these things can be true at one time. And this certainly plays into life, but also this economic story and the factors that we're looking where there's a lot of data going one way and then simultaneously the other way. So Jess, thank you for sharing those market observations. Tony, I'd love to shift back to you and let's hear your trade idea for today.
Yeah, today I actually want to look at the consumer, and specifically Jess talks about the consumer being more selective this year. But one part of the market that the consumers continue to spend on is actually travel. But recently we started to see some signs that hotel RevPAR, which stands for revenue per available room, has started to decelerate globally. And if we take a look at a chart here for Marriott, which recently printed a new 52-week high, in this environment where bookings and revenue is starting to decelerate, that could be a risk here. And I think that the recent highs here in Marriott might be the top that we might see for quite some time, especially as momentum in Marriott has already started to turn negative. The risk of a pullback here right now, I think, is higher than for Marriott to resume back to those 52 weeks high and potentially continue on higher. And if we take a look at the business here for Marriott, it does look quite expensive. It's trading at 22 times forward earnings, while analysts are currently only expecting about a 10% EPS growth over next year. And that's relatively low growth if you consider the fact that Marriott's trading at the highest valuation in terms of PE ranges over its past 10 years. So when it trades at historical highs in terms of PE, yet earnings growth is expected to be fairly muted, that's really where I see that Marriott is quite expensive, not only from a price perspective, but also from a valuation perspective. So I see downside risk starting to build here as travel demand starts to slow down a little bit, especially as we get towards the later half of this year. And I think earnings could potentially be a little softer here as well. And then when you look at the options, how to actually potentially play this, the implied volatilities on Marriott is relatively low, and that's expected when a stock is trading near its 52-week highs. And traditionally, you wouldn't consider this as the opportunity to be selling options when implied volatility is so low. But when I looked at the options and I looked at the skew of options, the difference in terms of implied volatilities of different options on the chain, I actually still see an opportunity where you can sell options here in Marriott and be able to be profitable if Marriott at least stays where it is or moves lower as I expect it to. So the trade structure that I want to look at is to sell a call vertical spread. And I'm going out to the September 29th weekly options, and I'm selling the 205 call options, and I'm buying the 215 call options. And that limits my risk on a option selling strategy here, collecting earlier today about $3.75 in credit to sell this credit spread. That comes in with a risk of about $625 per contract, with a maximum reward of potentially $375. And this collects roughly 1.9% of the stock's value in roughly 36 days between now and that expiration date. And just to put that 1.9% into context, over 36 days, Marriott only earns 0.9% dividend over a whole year. Here, I'm earning more than double that in just about 36 days by using a type of credit spread strategy, such as the one that I'm using here.
Thank you for sharing that. And so, Tony, so I clearly understand here that the goal is collecting a premium and then limiting our risk with this trade. So let's play out a scenario. So if you find that Marriott is moving against you, so in so many words, increasing in value, how would you manage this trade if you see that price approaching that break-even point in your assessment there?
Yeah, thank you so much for bringing that, because I always say that the most important thing to plan for is when the trade doesn't go in your favor, and making sure that you have a plan for that. It's easy to manage it when it's going in your favor, but when it goes against you, emotionally, it's tough to deal with. So it's always good to know exactly what you're going to do before you get in. And that's a great question. So when you sell a credit spread like this, in this particular case, I'm selling a credit spread that's $10 wide, the difference between the 205 strike that I'm selling and the 215 strike that I'm buying. And I'm collecting $3.75 of that $10. And the rule of thumb here for a credit spread is that if you lose 100% of what you paid, what you collected on the credit spread, that is a good time to say, hey, the directional view that I had on this trade was not correct. It's time to get out at a smaller loss than the full loss before I lose that full $625. So basically, if I lose $375 per contract on this trade, that would be when I would consider pulling the trigger and closing out this trade, again, before I lose that full $625 that I could potentially lose on this trade.
Nice. Thank you for that strategy. Great context, Tony. So Jess, let's move back to you. I want to, in light of the backdrop of your economic observations this week, what trades are you looking to place? And I know you're always looking to capture new opportunities. Love to hear about it this week.
Yeah, so this week I'm actually staying on that theme with newer home sales and the supply side issue that we're finding within the housing market, and looking at DR Horton, symbol DHI. So oftentimes, and to Tony's point and just the overall macro view that we've had in the beginning, rising interest rates tend to create a challenge for home builders and constrains the consumer. So something to be cognizant of. But if we're taking into consideration what we see with that resilient selective consumer and the income cohorts where that falls, in addition to the supply side of the overall housing market, DHI has a leading market share, and they have strategic efforts that are in place to navigate those supply chain issues, which makes them well positioned, in my opinion, from what I've seen from their structure. Now, from a technical perspective, they've found support on the July higher low of about 114. And I see the next resistance around the 50-day simple moving average around 123. But it's trading well above its 200-day moving average. And from a broader picture, we certainly look at that to see if it's in a bullish trend. Now, in order to take my bullish stance with this trade, I'm actually introducing a trade I don't think we've actually done on this show, surprisingly enough, which is a covered call. So with DHI at 118.04, about when this was priced, buying 100 shares at the current price of about 118, selling one call, approximately one standard deviation. So it's the strike price of 130, expiring October 20th for a premium of about $1.60. That means overall, I'm risking $11,644. Max reward is about $13.56, and that of course accounts for the premium that's received. And I think what's interesting about this, and since I led with, we haven't talked about a covered call before. Normally when I'm taking a bullish stance, we talk about cash secured puts, but I wanted to allow myself some capital appreciation with this one. So that's why a covered call, when comparing the cash secured put in order to buy the position versus a covered call, the covered call allows me to, or requires me, obligates me to sell the stock at that 130 strike price, which allows me room for capital appreciation, which I would not participate in when considering the cash secured put, just for some context around the trade thought process.
Yeah, thanks, Jess. I appreciate the context too. And similar to what Tony and I were talking about is, having an exit strategy here. And so I often see covered calls as just that, it's a built-in potential exit of the long position. So I'm curious to know though, if the price movement goes against you and it's not as bullish as you expected, how would you manage the trade then?
Yeah. So first and foremost, overall bullish strategy, the covered call or the short call portion of this would realize its maximum reward potential, and I would keep the entire premium, because on an individual basis, a short call is bearish. When we attach it to the stock, it makes it bullish, and we're utilizing that as our obligation to sell price. If it moves down, since now I'm going to be looking at the stock in my bullish stance, I would, one, want to understand why, and if it breaches my support level of 114, in which case, if there is some other catalyst, I would reassess my bullish stance, understand if my thesis is incorrect, in which case I'd close out the trade and move on to the next one.
Great. Thanks, Jess. Thank you so much. Helpful. So I want to shift now to one of my favorite parts of our time together, which is when we get to look back at some of the past trade ideas to see how they played out. Tony, I understand there's a trade that you placed that you wanted to revisit with us today.
Yeah, that's correct. A few weeks ago, I laid out a bearish trade thesis on UPS on the back of shipping volumes that are starting to decline, higher wage costs for UPS, as well as now we've seen Amazon further impede on their business model here with both FedEx and UPS. So back then, what I did is I purchased the September 180 put before UPS broke below that 180 support level. We've seen that stock break below that level, and now that 180 put that we purchased for about $5.40 is now trading at about $12.20. That represents a return on capital risk of about 125%. So in this particular case, when you buy a put option, you've made more than 100% gain on that specific trade, it's time to consider taking some profits. And that's exactly what I think we should be doing right now that UPS trading near that 166 support level, to start taking some profits on this trade.
Nice outcome with this trade, Tony. Thank you for sharing the reflection. Before we wrap up today's conversation, Jess, can you give us an idea of what's on the agenda for next time?
Yeah, so next time we will not be here, so that's important to note. But the following week, when we are back, we're going to have a lot of information to digest, particularly, of course, the market's reaction to Powell's speech tomorrow. We'll have to reassess those key technical levels that Tony called out, and of course, actionable trades. In addition to that, we also have a slew of economic data. Of note would be the employment situation, as that speaks to the broader picture and the inflation and restrictive Fed policy. So lots to digest within the next 2 weeks. So excited to talk about that.
Yeah, definitely a lot coming up. Fabulous. Thank you. And we're looking forward to that. So this does bring us to a close for today. And I want to thank our viewers for tuning in. Tony, Jessica, thank you for bringing us your thoughts and ideas today.
Thank you so much for having us, Roberta.
Thank you so much for having us. It's been a pleasure to be here.
Absolutely, always. And for our viewers, if you're interested in further details specific to Tony and Jessica's trade ideas shared today, please join us for our midday market briefing tomorrow by visiting fidelity.com/in-the-money-follow-up. And if you're looking for further insights and you might have missed the live show, be sure to sign up for the Active Investor Weekly newsletter to receive a highlight of the trades discussed. And you can visit us at fidelity.com/active investor weekly for that. And again, we will not have a show next week, which is August 31st, but we will be back in 2 weeks for another episode of In the Money. Take care.